Hey, Rana Gupta is with us, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good morning. Good to have you with us here. So there are two drivers. There is geopolitics and there is inflation in the US. Rates, basically. So geopolitics we'll get to in just a bit. But on rates, Rana, so there are many who are now saying, well, not many, but at least a few starting to say no cuts in 2024 by the Fed because the economy is doing just fine. The question, though, is, higher rates, 5.25, has not hurt equity markets at all. So the lack of lower rates, will it really hurt?
Hi, good morning. We always tend to talk about the rates, and in our last discussion, we highlighted that we started this year with some 4 or 5 or even higher rate cut expectations, which is now getting to 2, 1, or maybe even 0. Now, I think what is more important, and as we have been highlighting, that the Federal Reserve's stance of pause and rate cut if the need be. That is the most important stance for us. Should they change and look to hike rate, and which we think is unlikely, by the way, but that would be the risk. But we don't see that playing out as such, but that's a risk. The reason why I think the demand conditions, the economy is stronger than expected, because the financial conditions are not as tight as perceived. And the reason is the central bank balance sheets. Last interaction we spoke about Japanese central bank raising rates, but still they are expanding their balance sheet. Fed spoke about ending QT pretty soon. So the financial condition is not as tight. Therefore, rates would be a bit higher than than expected at the start of the year.
All right. So rates would be a bit higher. But how are you feeling about a market like India now? What is the best way to approach it, given that we're virtually sitting at all-time highs in the equity markets? Gold is surging. We have an election coming up as well. There's earnings season. How do you put all of those cues together?
Sure, I think this rates going to 10-year rate going towards 5%. Make no mistake, these are cyclical pressures, cyclical pressure of the market, or even geopolitical events, crude close to 100. All these are near-term cyclical risks. But in this, in these things, we should not lose focus of the structural improvements in India. And one or two things that you can mention very quickly here. I mean, despite all that is going on, I noticed that last month's India's trade deficit was only $15 billion. It used to be like 2022. Inflation headline is down to 4.9, core to 3.3. This is despite growth at 7% plus. I think these are very good numbers. This shows fundamentally the economy is growing by investment and productivity. And the way we would approach is to buy those segments which benefits the most. For example, the entire digital platform companies, they are getting market share from traditional consumer companies. So that's one area which you have liked. The very factor that their productivity and the investments are happening, so a lot of manufacturing and industrial companies we have continued to like. On the top of that, there are push towards renewable energy. So that is also one segment that we like.
All right. Hi, Rana. Good morning and good to see you. What about the Chinese market? I'm looking at the GDP print that's coming in there and the economic data that's come in earlier today. Well, that's a little better than estimates, at least most of those parameters that came in today. And that market, say in the last 45 days or so, it's showing signs that it wants to come back. Keep in mind, it's been a big underperformer. But what's your view at current reckoning with the economic data we're getting, with the measures that are taken, and also at these valuations?
See, I think Chinese markets is bouncing along the bottom, and I think they staged a comeback of 10-15% from the bottom levels. Although YTD they're not moving much, but the thing is that unless a decisive call is made by the policymakers there, either on the export or on the real estate, these markets will have some rally, 10, 15, 20% from the bottom. But to have a sustainable rally for the market, I think the problem regarding export and real estate needs to be resolved one way or the other. And or there should be significant domestic easing. The reason why it's important is that the China model has been build scale in manufacturing, export, get surplus, and invest that into domestic real estate infrastructure. Now that model is not working anymore because of the reasons known to us. So if that's not working, then we need a more significant domestic policy response, which has not happened as such. But the valuation is cheap, and anticipation, people are anticipating. So some rally from the bottom may happen, but for a market to give you good returns, I think something needs to change on the 3 parameters that we spoke about.
All right, Rana, we leave it at that. Thanks a lot for joining in. I appreciate your time here. That's Manulife Investment.